Welcome to This Explainer. Look, today we are going to shatter the absolute biggest illusion in the entire world of investing. If you've ever felt like the stock market is just this rigged game, or maybe you're worried you're missing some secret formula that only the ultra-wealthy know about, well, you are in exactly the right place. We're going to cut through all that complex jargon, we'll look at the actual hard data, and we are going to give you a crystal clear roadmap to building real wealth.
So I have a really direct question for you. Do you think you can outsmart Wall Street? You know, it's this massive beginner misconception that to build actual wealth, you need a fancy finance degree, a 6-monitor trading desk, or some highly paid team of experts in expensive suits managing your money. We're essentially taught to believe that professional fund managers possess some sort of magical crystal ball. But what does the actual data say?
Okay, let's dive into this. 90%. That is just a staggering number. According to S&P Dow Jones indices, 90% of active fund managers actually fail to beat the S&P 500 over a 15-year period. I mean, let that sink in for a second. These are professionals, paid literally millions of dollars a year to pick winning stocks, and 9 times out of 10, they lose out to a simple automated benchmark. So, if the highly paid experts can't even beat the market, what on earth should you do? Well, first, we kind of need to understand what the market actually is.
Which brings us to Section 1. Stocks explained simply.
Let's run the stock market through a 10th grade filter, all right? Let's just strip away all that complicated jargon. I want you to think of a publicly traded company like a giant pizza. When a company issues shares, they're simply cutting that pizza into millions of tiny slices. And when you buy a slice, a share, you literally become a part owner of that entire pie. It really is that simple. But here's the trick. You don't just want one flavor. Because if you only buy Hawaiian pizza, and then suddenly everyone decides they absolutely hate pineapple, the value of your pizza is going to plummet. And that is exactly why we use diversification. You buy a slice of pepperoni, a slice of cheese, maybe a slice of veggie. That way, if one flavor becomes unpopular, your other slices protect your overall investment.
And this brilliantly illustrates one of the absolute best analogies in investing, courtesy of legendary fund manager Ralph Wagner. He's said to imagine a guy walking his dog through New York City. The dog is highly excitable, darting randomly in every single direction on a really long leash, left, right, chasing squirrels, you name it. That unpredictable dog, that's the stock's price on any given day. But the owner? The owner is just steadily walking northeast at 3 miles per hour toward his destination. The owner is the steady underlying business. And the huge mistake most beginners make is they spend all their time intensely watching that erratic dog, instead of paying attention to where the owner is actually going.
Investor Jeremy Grantham has another really great way to picture this. Imagine standing on a skyscraper in the middle of a hurricane and you toss a bag of feathers into the wind. Can you predict exactly how high they're going to fly or how long they're going to stay up in the air? No way, not a chance. That is short-term stock market volatility. It is messy and it's totally unpredictable. But you do know one thing with absolute certainty. Eventually, gravity wins, and those feathers will hit the ground. Long-term outcomes are guaranteed by the actual weight of the business results, totally regardless of those short-term storms.
Moving on to Section 2, the S&P 500 secret. Let's pull back the curtain on this. So, if picking individual stocks is like predicting the path of a feather in a hurricane, what exactly is the alternative? Well, you probably hear these terms on the news literally every day. The Dow and the S&P 500. Let's clear up the difference between them right now. The Dow Jones tracks just 30 massive blue-chip U.S. companies, and it's price-weighted. What that means is a single company with a high share price carries more influence than a massively bigger company that just happens to have a lower share price. Honestly, it's a bit outdated. The S&P 500, on the other hand, tracks 500 large U.S. companies and is weighted by market capitalization, meaning the larger the actual company, the more influence it has in the index. It represents about 80% of the entire U.S. stock market, so when people say invest in the market, this is exactly what they mean. But here is a curiosity question for you. Do you think the S&P 500 is truly a passive automated index? Most people believe it's just this raw mathematical formula automatically grabbing the 500 biggest companies. But there's a pretty big secret here.
The S&P 500 is actually selected by a human committee. Yeah, it's not purely automated at all. A committee at S&P Dow Jones Indices makes discretionary choices about who gets in and who gets kicked out based on specific criteria like profitability and representation. For example, during the 2008 financial crisis, the rules explicitly stated a company needed a 50% public float to stay in the index.
Well, when the U.S. Treasury bailed out AIG and took 90% ownership, AIG should have been automatically kicked out. But guess what? The committee quietly suspended their own rules just to keep AIG in. So it is actively managed at the very top.
Now, what's really interesting about this slide is the massive concentration risk inside this supposedly diversified index today. Right now, the top 10 companies, we're talking real U.S. tech giants like Apple, Amazon, Microsoft, and NVIDIA, they control roughly 40% of the entire S&P 500 index. That means the other 490 companies combined only make up 60%. So when you buy the S&P 500 today, you're actually making a massive concentrated bet on just a handful of American tech giants. Look, it's a powerful wealth-building tool for sure, but you have to know exactly what's under the hood.
And because of that concentration, predicting the market is incredibly difficult. Beginners often think the stock market is like Newtonian physics, right? You calculate the trajectory, the speed, the gravity, and boom, you know exactly where the apple will fall. But the investment reality is much, much more like quantum physics. It's messy, it's totally unpredictable. Sometimes the very act of everyone observing a stock actually changes the stock's outcome. If it were a neat, predictable formula, well, everyone would be billionaires.
Which leads us perfectly into Section 3, Warren Buffett's winning bet.
This brings us to the ultimate proof of concept. If predicting the market is like quantum physics, and 90% of active managers fail to beat the S&P 500, how do the smartest billionaires handle this? Well, in 2006, legendary investor Warren Buffett literally put his money where his mouth is. Standing in front of 20,000 people, he issued a challenge. He bet $500,000 of his own money that over a 10-year period, a simple, incredibly boring S&P 500 index fund would completely crush any complex, high-fee hedge fund strategy Wall Street could throw at it. And spoiler alert, he won that bet easily.
But listen, Buffett didn't just pick any random fund. He had very strict criteria to make sure Wall Street wasn't quietly draining his returns. First, he demanded a fund that accurately tracked the S&P 500. Second, he demanded no sales commission, which is often called a load. Third, he insisted on a very low management fee, because honestly, why pay an expert to do nothing? And crucially, the fund had to allow for automatic dividend reinvestment. He ended up choosing Vanguard's 500 index fund Admiral shares. It was straightforward, incredibly simple, and ridiculously effective.
All right, let's get practical. Section 4, 4 steps to wealth.
So we have the theory down, and we have the proof from literally one of the richest men on Earth. Let's see how this builds into an actionable plan that absolutely anyone can use. You do not need a finance degree to execute this. Here is your step-by-step blueprint for building long-term wealth. Step 1, invest in a low-cost S&P 500 index fund, exactly like Buffett did. Step 2, dollar cost average. Now this just means you invest a set amount of money every single month, totally regardless of whether the market is up or down. It completely removes the emotional guesswork and the impossible task of trying to time the market. Step 3, automatically reinvest your dividends. And step 4, be incredibly, remarkably patient. You just got to let the oven bake the pizza.
And that brings us to our final section. Section 5, your key takeaway.
This is the emotional payoff of this entire explainer. We've talked all about what to buy and exactly how to buy it. But there is one ultimate secret ingredient that Wall Street literally cannot sell you, and that ingredient is time. So the crucial point is this: 97%. More than 97% of Warren Buffett's immense multi-billion-dollar wealth was accumulated after his 65th birthday. I mean, think about that for a second. He didn't build the vast majority of his fortune in his 20s or 30s or even 40s. He built it at an age when most people are packing up to retire. Why? Because of the absolute most powerful force in finance.
Compound interest. This is the phenomenon of earning interest on your interest. Remember those pizza slice dividends we talked about earlier? Well, when you reinvest those dividends to buy more slices, those new slices actually start generating their own dividends. It creates this massive snowball effect over decades. The main takeaway here is profound. You really don't need a lot of money to start building wealth, but you absolutely need a lot of patience. You just have to let the snowball roll.
They say the best time to start rolling your snowball was 20 years ago, but the second best time is today. Look, if you found this structured breakdown helpful, make sure you hit that subscribe button for more clear, visual explainers just like this. And to ensure you have the safety net required to actually leave your investments alone to grow, click on your screen right now to watch our explainer on how to build an emergency fund. Thank you so much for learning with me today, so I'll leave you with this one final question. Are you going to keep watching that erratic dog, or are you finally ready to focus on the steady owner?